Nitin Raheja is also joining us from Julius Baer. Nitin, all three of you, good afternoon. Thank you so much for your time. Nitin, let me start with you. The broad view is now emerging that India, for the time being, may enter a price correction or a time correction because of valuations becoming challenging. However, large caps remain attractive. Do you subscribe to that? What is your own activity in the last, say, 15, 20 days when indeed some early glimpses of correction have actually started in the market?
So, I mean, we've been saying this, in the last many times that we believe that, it's time to have a large cap bias in the portfolio. And I think because there were telltale signs of euphoria that we were seeing clearly in the mid and small caps. Having said that, we have definitely seen a correction. But when you look at the correction, to the extent that we've essentially seen them revert back to the levels closer to December. And don't forget, this whole rally started in June, July of last year. So we've had almost a 50% plus gain last year itself. So while there has been a correction, I don't think the correction has brought valuations to attractive levels. If you look at it anecdotally, by and large, although there might be some pockets that you will start seeing that could sort of stand out of the pack. So we continue to believe that large caps is the space where you should be, and we have a very large tilt towards the large cap space today in our portfolios for clients.
Right. Nitin, obviously, large cap space is what you're looking at as well. But, when you're looking at it today also, there are so many of these names that have seen a sharp fall in the large cap space. So specifically in the large cap, anything that you would look at, which sector or which specific stocks would you look at then?
So, I think one of the key areas that we are seeing is financials, right? What's happened is everybody hitherto was bullish on financials. The last quarter results came and you saw margin compression and this whole challenge of raising deposits. Now, suddenly we've seen brokerage houses turn cautious on the whole financial pack. Also in the public sector financials pack, we've seen a correction also take place across. So financials is obviously one pack which sort of stands out there. We are also seeing telltale signs of the chemical companies actually starting to show resilience in terms, and also prices of base chemicals starting to move upwards. So you've seen that. So that pack is again the other pack that is starting to look very interesting from an investment perspective. And we would keep a watch for the infrastructure space. If there is a correction out there, especially towards the power transmission side of the business. If you see opportunities come there, I think that's where one should be looking to sort of use this correction as an opportunity to get in.
What this slip below the 21,800 mark is telling you, and when it comes to the mid and the small cap indexes, do you think that last week's pain or last week's shake-off was not the first time we're going to see that kind of weakness come in again, perhaps?
So the one pattern which is very clear is that it's selling on low volumes. So the volumes which were there last week when that mid-cap so-called capitulation day happened, and the volumes thereafter in the next 3 or 4 trading sessions, the volumes for those mid-cap names is on thinner volumes. Even if it's a bounce, or even if few of the mid-cap names which have gone through a further leg of correction for themselves, which generally indicates that maybe the major pain for most of the stocks which have corrected or were participating in that leg of correction, I think that seems to be out. But the pain is still left into those larger cap names, the heavy-weighted sectors, which were still underperforming. For example, the FMCG stocks were underperforming, and today you're seeing those classical signs where the volumes have come back again and these stocks have made a fresh swing low. Positively, the metal stocks which were doing pretty well yesterday, they have not retraced completely. So that generally indicates that the momentum is still there into these stocks largely, and maybe a couple of days of pause for these stocks, and post that we may be expecting a breakout. But I also believe that this 21,800 mark, 21,750 to be precise, is a very strong support, and I think if we manage to break below those levels, maybe the near-term trend for the Nifty could get a bit more dampened.
Okay, near-term trends seem to be more dampened if these levels are not maintained. Naresh, what's your thought coming in also in terms of the mid and small cap as well? That's not seen any sort of a relief or anything coming in on the positive side for this one, and clear pressure coming in and there. So, do you think this is going to be continuing? What are the charts for the mid and small cap?
So overall, if you look at it today, at least on the day when the Nifty is correcting 1%, and the bank Nifty is correcting 0.5%, you are not seeing a 1.5% cut on the small cap indices as well as on the mid cap indices. So that's a good start in the correction. We are normalizing. We are not seeing a sharp fall in the mid cap and small cap indices. So overall, this indicates we are getting into a consolidation mode for the whole market as such. Until now, just a few weeks back, it was all about small caps outperforming. For the last few sessions, it was large caps outperforming. But now we are getting into a band. So now 21,600 is the next price point to watch out for the Nifty. The small cap index, till the time it holds above the recent lows also, we could see this consolidation continue. So we are in the period of time where one has to be careful because a lot of stocks will not see follow up the next day. We've seen that happen quite a few times over the last 2-3 sessions. So overall, getting into a consolidation mode for small caps as well as for large caps.
While the market may be in a consolidative mode, there's one group in the market, the Birla group, which is making big shakes as far as all their businesses are concerned. Nitin, have you noticed the way Mr. Birla, almost, gave out the guidance for their paints business under Grasim, 10,000 crore revenue. We were speaking to Century Realty recently. They have high ambitions to be among the top 3 or 5 players in their field in India. And we all know how AB Capital is now raising capital and merging companies into itself, perhaps trying to close the discount which it trades at. One is getting a sense that the entire group is Novelis wants to list in the US. There is something heightened activity in that entire big bold moves being announced. Anything you like within the Birla group, and how are you observing this?
So, I think when you look at it, I think it's a welcome sign, considering that, it's a group which is sort of very well respected and would, find favor with institutional investors. However, over the last, few years, it's sort of struggled from a whole wealth creation perspective. And, any effort that is being made today to sort of become a little more aggressive towards that, as well as to try and, unlock value for shareholders, I think this is all very, very positive and welcome. I mean, we've seen what has happened to the other groups who made such changes and actually unlocked values. So I think it's a good sign for the market. It also sort of helps you to broaden the market and actually presents opportunities for investors.
Well, we are back with the latest edition of Times Now Summit. Over the years, Times Now Summit has been championing the pertinent national agenda points where India's leadership, leading thinkers and national influencers come together to define the action plan for India's progress. Themed India Unstoppable, this year we're going to be focusing on charting India's remarkable journey and its increasing influence on the global stage. So join us on the 27th and 28th of March in New Delhi and watch the who's who of the political corridors share their views. Do stay with us for all the highlights and all the action as it begins right here on the Times Network.
Right. So Nitin, I was pretty surprised about the point which you just made on chemicals. You are seeing early signs of pricing pressure stabilizing, and hence you are actually nibbling into select names. There's another pocket I'd like your opinion on, is the FMCG space, which has witnessed a lot of pressure on the volume growth and of course downtrading by a lot of a big large section of consumers because of high inflation, etc., particularly in the rural side. But first, let me put some data on the table regarding how, I mean, HUL of course is at a 52-week low, but many others, how the valuations have got compressed. I'd like to speak about it with Vinny right here, and then we'll get your opinion on that entire pocket. Vinny, how the valuations got corrected over the time?
So when you're looking at valuations overall also, when we just look at the Nifty FMCG index, last 1 year also we've seen that fall coming in from the peak. And normally, when you're looking at it overall at the index level also, the range between which when we start seeing a reversal for the FMCG index comes in only somewhere around the 25 times to 30 times. So clearly, as of now, when you're looking at the 1 year forward PE for the FMCG index as such is at around 37 times. So yes, the lowest has been 34. Maybe if that fall continues, then after that there could be a possibility of a reversal. But clearly there are no triggers, Ajay, that we see actually coming in for the FMCG sector as well. Everyone was going on in terms of that hope having on the rural recovery. Right now, channel checks are suggesting that that's not coming in Q4 as well. Rural recovery has been very subdued. Maybe this time around that growth in volume also could be below that low single digit level that we have been seeing in the last couple of quarters. So mid single digit is out of question, but low single digit is what the expectation is coming in. Raw material prices, again, when you look at palm oil prices, that's seeing a bit of an increase coming in. Sugar prices a bit increase on that front as well. So that again concerns coming in on that front, because the deflation in raw material prices now that they were expecting has moved on somewhere to the second half of FY25 is what one could say, not before that. K-shaped recovery, that's what is continuing. So only premium doing well, mass not doing well even as of now, and Holi, Eid and Q4 something, they're not seeing a support coming in from these festive season as well. So that is a trigger, a headwind that we're seeing no positive sign coming in for that FMCG
Fair
side.
point.
Nitin, would it translate into a contra buy for you, or would you say give FMCG a skip because of what Vinny just highlighted?
No, I mean, FMCG is really a defensive play. If you believe that the markets are, going to correct in a big way, that's where you go. But otherwise, if you really ask me from a valuation perspective, especially when you look at the kind of growth numbers that have been happening out there, clearly it's not very attractive to be there. And, more so if the markets are correcting, you are going to get pockets of opportunity that are going to come in places that are seeing substantial correction. So, I'm not really a big believer of the FMCG play, especially at these valuations.
Stocks then. Battery stocks have got, I mean, there are only 2 battery stocks and they've gotten corrected almost 20% from recent top. And now there's a certain section of the analysts who believe that technology could be an issue for many of these companies if they want to progress on the lithium ion side of their business. And this, after both these groups have actually invested quite a few hundred crores in their lithium ion kind of projects. Any thoughts on Amara Raja or Exide?
Sorry, is that for me?
Yeah, Nitin?
Yeah. So I think this is a place where technology is yet evolving, and Indian players are yet quite down the curve. I would probably be a little wary, and you can see that in the kind of terminal valuations that these businesses are trading at today. It's a sector that I would probably, even if I have to play the electric sort of conversion that will happen, I think there are better places to look at. I wouldn't, not at least not at the present moment in the Indian battery.
Right. What about the charts, Nuresh? Exide and Amara, corrective phase may continue?
So in the near term, yes, that is what it looks like. You've just given a short-term breakdown on Exide. As such, it could correct towards the 270 mark, and that could be a point of time where it could stop. Amara Raja, on the other hand, I would still avoid, because that was a stock which did not show a very strong trend compared to Exide. So for now, it's time to wait it out. The stocks have corrected 15%, but the recovery has not been swift. So I would wait it out.
That's the view coming in on Exide and Amara Raja from on the charts as well. But let's move on to an ET Now exclusive. We learned from reliable sources that Vodafone PLC will soon sell stake in Indus Towers. My colleague Cheryl D'Souza is joining in with us to give us more details on that. Cheryl, take it away.
Yes, let's put the spotlight on Indus Towers. It's an ET Now exclusive. Sources have told ET Now that Indus Towers, we are likely to see a block deal in Indus Towers pretty soon. What we are picking up from our sources is that Vodafone PLC is likely to sell stake in Indus Towers via block deal. Remember, the Vodafone PLC holds a stake in Indus Towers via Mobile West, and Mobile West for now holds about 8.59 crore shares, which actually translates to about 3.2% stake in Indus Towers, and the block deal could be likely in the range of around 210 to 220 rupees per share. But also what would be very key to actually point out or to note is the fact that the Mobile West stake that they're holding in Indus Towers is actually pledged. We did write to Vodafone PLC to get their views on this particular deal. They're yet to respond to ET Now queries. And remember that post this particular stake sale, the Vodafone PLC will own about 17.85% stake in Indus Towers. So what we're picking up for now is that Vodafone PLC is likely to offload some of its stake in Indus Towers, the stake that it holds via Mobile West. And Mobile West, like I mentioned, holds approximately 3.2% stake in Indus Towers. Remember in early Feb also we saw a couple of entities offloading their stake in Indus Towers, one of them being a KKR entity also, which actually offloaded about 4.8% stake in Indus Towers, while even you had CPPIB also that actually sold about 2.14% stake in Indus Towers. So very soon we are likely to see another block deal in Indus Towers. This time around, Vodafone PLC stake held via Mobile West will be offloaded.
Okay, that's the buzz that we're picking up right now on Indus Towers. In the meantime, let's just take stock of some of the other names. Axis Capital has come out with a note on Exide, like we were just highlighting, the stock down by about 3 to 4%. Jefferies has come out with a very interesting note on Piramal Pharma. They're putting a target price of $170 on Piramal Pharma. That stock is actually holding up in the green. They're saying that the funding constraint is leading to order slowdown for CRO as well as CDMO firms globally. And their model, marks a 12.5 to about 30% revenue to EBITDA growth for FY25 under the base case scenario. And they believe that Piramal Pharma can actually do better than that. They're saying that the sensitivity analysis actually suggests a 15% revenue growth could drive a 45% EBITDA growth for FY25, and thereby they see upside further in Piramal Pharma right now, which is holding up 3.5%. I think the volumes as well are way higher than the 10-day average on Piramal Pharma. Kunal, let's get a chart check going on Piramal Pharma if you see this one.
Well, yeah, I think it's come back to the 200 DMA, 120, 115 was the low for Piramal Pharma yesterday or day before, and I think from there the stock has managed to see a bounce back. Now, good part about the chart so far is that the sell-off which had happened for the stock from I think 145 or 150 odd levels was on thin volumes, and now the stock has managed to bounce back, which means that this 115 odd mark which was tested in the last couple of days, that should act as a short-term support for Piramal Pharma. And I also would probably expect that the indicators would come back into a neutral territory. So right now the indicators are extremely oversold for the stock, and I think that's why you're seeing a bounce back into the stock on the back of higher volumes. Once that stabilizes, and assuming if the stock doesn't break below this 115 levels, I would believe it's a good level to buy.
Okay, that's the chart check coming in on Piramal Pharma as well. But, Nitin, I just want to know in terms of overall, what's your view on the pharma pack as well? Is that something that you would be playing as a story right now more on the defensive side?
Oh, yes, absolutely. I think, pharma is a it's like you said, it's become the defensive sort of part of the portfolio. That's because, if you look at different aspects of pharma, if you take the generic pharma, you're seeing a shortage out there. You're seeing pricing having bottomed out there. And so that started doing well. If you come down to domestic pharma, that continues to sort of show good demand, and it's actually quite a turnaround. There was a time when generic pharma used to trade at a premium and domestic pharma at a discount. Today, domestic pharma actually trades at almost like quasi, although not as expensive, but quasi FMCG type valuations. So I think, but with growth also sitting there. So I think it's a good defensive place to be today as a part of your portfolio.
Right, Nitin, thanks very much for joining us on the show.
If you like this video, then like, share and subscribe to ET Now.